All right, everybody, welcome back to the Cash Flow Chronicles Season 3, Episode 3, September 30th, 2025. It's always a great day to be back here with Mr. Cash Money Patel. Excited to be here, as always, for Season 3. No midstream ads, so hopefully you guys enjoy that. Let's just do a quick rundown. I was surprised by the first one on the ticker. Apple, back above $2.50 a share. Amazon taking a breather at $218.99. Dutch Bros coming back to a reasonable price at $52. Maybe we can touch on that. Google $242.50. Palantir $181 per share. Rocket Lab $47.50. SPY $664. The Qs $598. Bitcoin just below 115,000. Oil trading in the low 60s, and Henry Hub gas $3.35. Hopefully you guys give us an opportunity to hit that like button. And before I hand it over to Mr. Patel, contemplate becoming a member or subscribe. Subscribing is completely free, allows you to participate in the chat. Mr. Patel, how are you doing?
Good, man. Just like we were talking yesterday, I'm looking for opportunities in this market. It's just not a lot. There's a lot of things have been running. We're hitting some all-time highs again. Markets. I mean, the market's okay. Fear and greed is like right there in the middle. So, I mean, there's still pockets out there. I do feel a bit of not buyer's remorse on Robinhood because I've been using their product for like forever. I've had premium forever. I just loved it. And for some reason, I've always just been like, I'll buy the dip. And it's just never happened. And now I'm kind of like, man, should I just buy it? And it's like, it's already kind of run to about 120, 130 billion dollar market cap. And I'm like, God damn it. I'm super bullish on brokerages in general. Because I think this is something when I was at the Robinhood Summit, I noticed, and this is something I posted as well. The casinos were pretty much empty. Like if you see like the amount of people there, like at the Wynn, there were still a good number of people, but at the place that we were, barely anyone was on those machines. And then at Robinhood Summit, you could just see the amount of interest and demand there was. So I got to thinking, and I was just like, wait a second, like this thing is literally a casino in your pocket. Like, why do you need to go and like do that? Like you got much better odds on this thing than you do on going to Vegas and spending money on a ticket and hotel and everything else. Not to mention Vegas has gotten a little bit expensive too, so that's another thing. But so when I noticed that, I realized like, wait a second, there's an active group of people that will slowly discover these prediction markets. And like 2 weeks ago, I just made a quick like bet on a couple of games on there, right? For like football and stuff, just to try it out. And I was like, this is quick, it's addictive, and there is an inbuilt audience that's going to just eat this up. And it's not going to be like, like a thing that plateaus. I think this thing could be like multi-billion-dollar business that eventually translates into pure profit for Robinhood and Kalshi and everyone else involved in it. So I'm like super bullish on that. And then today they announced news that they're going to do the same thing for they're going to try to do the same thing for Europe. And I was like, wait a second. Though I saw the comment section on Robinhood and people were like, man, I wish they let me do this for cricket. And I was like, bro, Indian people freaking love betting on cricket and all these things. Dude. So you're talking about
can you imagine the India-Pakistan game, bro?
Yeah, man, it's insane. It's insane. So I think this is the part that really gets me. And I was just like, wait a second, the total addressable market for sports betting is huge. And the thing is, if you can get people to kind of be in that Robinhood ecosystem and then utilize those prediction markets. I mean, and not to mention there's other things that are non-seasonal as well, like this whole thing with the government shutdown. I mean, if you go to Kalshi and you look at how many people are wagering on the government shutdown thing, it's insane. South Park is doing episodes on it. So the trend is definitely there, and the opportunity for massive amounts of growth is there also. So my only thing is valuations now have gotten high, and you know me, I'm old, I'm dogmatic. Sometimes I wish I was less dogmatic and I was just like, and I've been trying to practice that myself with just using the Stanley Druckenmiller thing, just if you see a trend, just buy it and then do the research later. But it's still hard for me to get around that. But yeah, Robinhood has been killing it. I have a position in Webull, which I think will eventually catch a bid as well, because they're doing very similar things. So, and the valuation on them, they're a much, much smaller company with a much, much smaller market share. But even if you are at 10% of what Robinhood does, that's still significant upside for them. So, it's one of those things that I think there's unique benefits to Webull. I think me and you, we spoke about it the other day about trying to dog food their charting and their what is it called? Their
Application
watch
on
list.
iPad. Yeah.
Yeah, because I think if you try it, you'll see it is a really good product, and there are a good number of people that are very much into the Webull ecosystem. And so, if they can even remotely replicate the success of Robinhood, then that's huge value driver for Webull. So I'm cautiously optimistic about Webull, but I think if they can learn a lot of the lessons that Robinhood has done, which is doing really good shareholder outreach, making sure that they simplify everything, and just build upon that platform. And they have a global reach as well, to just keep expanding on it. So I'm super long on brokerages. I think at some point, right now in the US, the total number of people investing is about 40-50% of people that actually invest. Around the world, it's actually in the single digits. So I don't know if you remember when we went to go see what's his name, Zach, in Mexico, and his I think girlfriend, I'm not sure if she was fiance yet, but girlfriend was actually showing me her phone, and she's like, "Oh, look, investing, blah blah." And she was very new to investing, but it's really interesting because more people internationally are starting to kind of get into the markets, right? Because you could be on a beach in the middle of nowhere and you have like the ability to actively trade. And I think that's the thing. So the total addressable market for brokerages in general is going to be significant. One of the things, if you look in the comment section of any Robinhood post, is, when are you guys coming to Canada? When are you guys coming to Europe? So I think the total addressable market is just insane. So, yeah.
No, I echo that heavily. I think it's because of the mobility of an iPhone, of the Android, that people are able to really start to get involved. And I mean, I remember trying to talk to people about stocks back in 2012, 2013, when I just started working, and it was like a foreign concept, right? No, I don't know how to use Fidelity. It's complex, etc. But when Robinhood started coming out, even all the way back then in 2014, which should have been foreshadowing, to be honest, but back all the way in 2014 when Robinhood was out, like everybody and their, brother was starting to open up an account. And they were giving away free stock and everything the like. And so, but I will say, and I said this in jest, of course, I don't actually wish this. But Robinhood can go to fucking zero. And the reason being is because, and I said this in jest, I bet on Penn State to win over the weekend, and you can't win a goddamn football game by playing 1/8 of a damn football game, okay? So they didn't score. They scored 3 points, okay, until like the last 6 minutes of the goddamn game, and then they decided to show the hell up. And next thing you know, so I don't understand how you expect to win, like, against a top 10 team. So anyway, that's why Robinhood can go to zero. I lost $50 and I'm livid. I now live under a bridge. This is a green screen behind me. Just kidding. But no, and in all reality, I think that you're right. And people are saying, oh, well, cricket's banned, or not cricket, gambling's banned in India. Well, keep in mind, gambling is also not necessarily allowed for like DraftKings and everything like that in Texas. And I'm still able to use Robinhood, and they asked for my address and everything like that. And not only that, but you think about it, we lost Chris, but even if you think about the like India-Pakistan cricket match, for example, that's not just like people in India that are potentially going to look at that and gamble. Think about how many people nationwide. I was in Trinidad watching that match. And people, like, the whole pretty much whole country of Trinidad and Tobago shut down during the India-Pakistan match. So to watch it, right? So you have people nationwide, worldwide watching that sort of stuff, and that's just an opportunity for everything. So anyway, I'm excited for the prospectivity of Robinhood national, worldwide, internationally, and Webull and many other great opportunities. And I'm excited because I've seen so many people paying $30 goddamn transaction fees for too long. And I feel bad for people. I stopped paying that back in 2014, 2015. It's time for the rest of the world to get on board.
Yeah. So because of this, originally I was going to just do this like a Patreon only thing, but I figured this is a good time to kind of like show a certain thesis and show like how, I don't know about you, Matt, but how I craft like my brain works in trying to find what is it called? Opportunity. So I saw this tweet today from Vlad, and let me actually pull it up. And I think this is going to blow people's minds when you see it. And there's actually real opportunity here. So let me just.
I'm glad you brought this up because I also saw something today as well that maybe I can piggyback off of. So
okay,
I'll let you go first.
So, yeah, so let's do this. So today I saw this post from Vlad about Q3 was our biggest quarter yet. Shipping Robinhood Gold cards were up 450,000 cardholders with 45% growth this quarter, right? So everyone's like, oh my God, this is super bullish for Robinhood, which totally agree. They're probably going to make some money off of this. But the question that no one seems to be asking is, who issues these cards? Who is the chief person and bank that's responsible for this? Because Robinhood is a brokerage. So they have to partner with someone to issue the cards. And at the same time, they have to do that with the banking situation. Well, if you did just a little bit of homework, you ever heard of a company called Coastal Community Bank?
Yeah, actually.
Right? Coastal Financial Corporation. These guys, literally in the last year, are up almost 100%. They're $1.63 billion company, right?
I might be thinking of a different Coastal, sorry, but yes.
Yeah.
I've heard of Coastal, but maybe not this one.
So crazy amount of like share price appreciation. But one of the main things that they do is partner with Robinhood. Right here. Right here. They partner with Robinhood to issue all of these cards. So if you think about it, if Robinhood is adding this many people to their gold cards, that means that is probably going to come into this thing as a growth driver as well. Okay. So like I said, still got to do more due diligence, make sure I understand the terms of the deal that they have. But basically, these are the guys that do the work for Robinhood to do all the other stuff. So let me just look if they mention anything Robinhood. I have to do more DD on the banking side of things, but look at that. Compliance, partner activity, T-Mobile. So they partner with a lot of people. Let's see. Loans platform. So you remember the mortgages thing? I think the Coastal does that too for what is that thing called for Robinhood. So I have to double check on all of these things and basically do my due diligence on these guys. Because if this is the company that is doing all this stuff, I have to look at the deal terms as well from Robinhood. If Robinhood is partnered with these guys specifically,
it could be a good opportunity. Yeah, that could be a good opportunity. That's interesting. I mean, small regional banks also. I mean, I know that's obviously an arbitrage play with respect to Robinhood, but I think some people forget that some of these small regional banks can really have favorable, what is it, CET1 ratios? Is that what they were? Yeah, and they're really well credited. Like I was looking at the bank that's in my mom's town, and I was like blown away at how profitable it is, and they're publicly traded. I was like, I might take a pretty big position in this. Anyway, interesting. That's pretty interesting. I'm curious though, do they own Sage Home Loans? Because I thought that was who the mortgages were, You're muted. You're muted.
No, you are correct. It is Sage Home Loans. It's different. It's someone else that's doing that. So
Okay, yeah, because I've been I'm obviously keeping my eye and ear to the street, looking for whoever has the cheapest home loans, and because I have many loans
yeah,
that I need to refinance. So
yeah, yeah. So
it's like trying to find a needle in the haystack. Like I don't know if they are just backing off on the home loans or if that was like a quick trial or what.
Yeah, so these guys are issuers of the Robinhood Gold Card right here.
Did I see that they also do Dave, like Dave and Buster?
They do Prosper, which is like the unsecured, like what are they called? The personal loans, Pomelo, Scene, Possible Card, all of this stuff. Yeah, like I said, I don't know the deal terms on how they make money off of Robinhood Gold cards, but there's definitely some, connection there that increase. I mean, over time, that partnership, if it wasn't shareholder accretive to these guys, they wouldn't do the deal. So there's definitely some deal terms there. I just have to figure out from a valuation standpoint, like what's the actual tangible benefit to these guys. But like I said, rapid growth in memberships, and these guys are the primary card issuers. It's like I said, more research on this one, but this is where my head is at. And if you see, dude, 100% growth year over year in the stock price, I wonder if there's something there.
Yeah, it's interesting. I mean, are they trading like richly valued? Or
not really.
No?
Not from what I could see. Their PE is 33, but let's just take a deep dive into their. You know what? Freak it. Let me just do the actual, like, pull up the data, and we can analyze it together. Let me just share screen window. Damn it. I have to share like an entire screen. Sorry, guys. Okay, so you might see picture in picture. So, okay, do you guys see my screen or no?
I see New York.
That's my background. Let me put it over here. There we go. Okay, you might just see me turn to my second monitor. So CCB, Coastal Community Bank. So this thing, it's $108. Shit, man. This is one to have been watched out for when the gold card came out. Look at that. From April, $38 all the way to financials. By the way, if anyone's wondering, this is a Fiscal AI. I love this tool for due diligence work on companies. Sometimes it's a little bit incomplete, but for the most part, they have like a really good charting platform. So that's their net interest income. For now, I just want to see their revenues. So if I can't find it, I could always just search right here, which is cool. Total revenues. And you can see credit losses. Just want to see plain revenues, man. Revenue, CAGR. Whatever, total revenues. So their total revenues and I like doing, see this last 12 months trailing. That usually is one of my favorite features because a lot of times there's seasonality. So
yeah, I love LTM.
Looks like their revenues have been going, but somehow they've kind of been coming down a little bit. Net income has been kind of flat. It says 0, but that's probably because it's such a small cap. So let's do millions. Yeah. So net income is about 47 million per year because this is last month trailing. So their margins, so their revenues have been going up, but margins are probably staying flat. Gross margins. Let's look at their EBITDA, and I will look at their, where is operating margins? And for the operating margins, you can just click this and it toggles a separate thing. What the hell? How come their operating margins are not showing up? So their EBITDA is actually really low. Why is it so small, man? See, this is the challenge. So even if your revenues are growing, your net income has not been going up. Your operating margins the operating margins have improved. They were making about 1.6 billion about 2 years ago. Now it's about 5.8. I wonder why. Their operating margins right here, 1.3, and it's 5.8. Oh, it's probably a scaling issue with this thing. So let me do. It's not showing. All right, let me get rid of some of this other stuff. So get rid of EBITDA. Huh. For some reason, it's not graphing. It's operating changes. Whatever. Maybe it's because it's too small.
Interesting.
Yeah.
Maybe because it's interest income. It's not really operating. I don't know.
No, it should be operating income. I mean, net interest income is growing significantly, but it looks like they've been like spending a lot too. So if you look at their net interest income has been growing, and this is their non-net interest income, which has kind of gone down a little bit. I wonder why. See, this is where I'll have to like look into their like slide decks and figure all this stuff out. Investor relations. Let's see if they mentioned. This is the thing about banking, man. It's just a lot of freaking reading. All right. I'll take some time and do the research on this, but this is the AI generator report, which is okay. I like to do my own. So let's see. See, this is the weird thing. This actually shows revenue and operating income. Why doesn't it show in the other place? So the
It just shows revenue. There is no operating income.
No, it says revenue. And oh yeah, that's right. Why don't they show that?
Because it's from interest and other things. I don't think it's like an actual, like when I think operating income, I think like facilities and.
Yeah. See, the thing is with this one, it's such a small company that you really have to like dig down deep into this thing. Yeah, I'll have to do more homework on this one and go through their earnings. I thought this was probably growing at a much faster pace, but it seems like they've kind of been going the other direction. Maybe I'll wait until next quarter to figure out what's going on with these guys and how they're projecting this out. And then also, why has the stock been going up if their metrics have been kind of plateauing or going down?
Yeah, it's interesting.
Yeah. Definitely got to research this down right here. That's always, whenever I see that, that's always concerning when it's moving this way. I always like seeing up and to the right. So when I see the opposite happen, it's like, like what's going on? What's going on with the business? So it could be something seasonal, maybe. But
it just goes to show you, like, just because the stock's going up doesn't necessarily mean that the underlying is doing well. And it's same thing vice versa, right? Just because the stock is the price is going down doesn't mean that the underlying is doing so. Like, I think so many times people just assume that because the stock is doing one thing that, prime example of this, right?
Yeah.
I think like the stock is going the opposite direction, but I think a lot of the numbers are going in a pretty good direction. So it's interesting in that respect, like why, right? So margins or not margins, multiples expand and contract, right? Like right now we're in a very expansive, and this is something like that I think people should hopefully take, not just for Novo Nordisk, not just for Robinhood, not just for Coastal Bank, but just in general, right? Like back in 2014, Apple was trading at like a 12 PE, right? Now Apple is trading at a 35 PE. So even for $1 of earnings, right, it was trading for 12 times. Now it's trading for 33. Like the valuation can be 3 times as large for the same dollar of earnings, right? So that's something that people need to be kind of considerate of. And sometimes the market warrants that, sometimes it does not. And so that's something to always be cautious of. But I think this is a good example, and I'll let you kind of talk through this one.
Yeah, if you look at Novo Nordisk, Novo was growing at a very rapid pace. And because of that, they were getting a big premium to a lot of other pharma companies. And so their growth, because of like introduction of Eli Lilly's Manjaro, and then also the compounders, the growth rate started to slow down. It doesn't mean that it's not growing, it's just slowing down. And so what you're seeing is growth went from 31% now to like 20. And because of that, the stock has been re-rated much, much lower, right? So if you look at the PE that it used to get, let me see the ratios. PE, and I tend to look at PEs on a forward basis. So if you look at the forward PE on this thing, right, it went from right here about 42 to now 14. So that's what typically happens, right? If you start to slow down, if your growth rate starts to slow down, then the next thing to happen is your stock is actually going to re-rate to that lower growth rate. So let me just get rid of some of the other things. So just
and our margins slipping, like I still don't like. I understand revenue growth is slowing down, but it's not like it's going from 31% that we saw late half of 23 to 5%, right? We're still growing, as you saw with the revenue bar chart that I don't.
Oh yeah.
But the revenue is still growing at a massive clip. So like, I'm kind of scratching my head. I haven't done the due diligence other than the fact that I know that revenue is going in the right direction and that they're not hemorrhaging cash. But like, what is the real reason other than people are just cooling off on?
Well, it's the growth prospect. So if you look at this, let me just change the color of that net income. Net income is right here.
Yeah,
let me just pull it up. Dude, if you're a content creator, this is by far one of the best platforms for charting. So, just do this because it might be easier. So
yeah, I know we talked about this one like 2 or 3 weeks ago. This just doesn't make sense to me.
So as you see, the net income is all-time highs, literally just climbing up and to the right. So always makes sense to be there. But at the same time, that growth rate, it's number one, you've got three things working against it. You've got all these competition and all that stuff, which is totally understandable. But at the same time, remember, it's the law of big numbers. It's really hard to keep replicating that same growth trajectory. And so a lot of people, they oversell these things. So if you look on a net income basis, it's been freaking great. That's why the PE is going down, net income is going higher. And so this is just graduated from growth company to value company. And that's the challenge that a lot of companies have. Another good one to look at is PayPal, right? If you look at PayPal, their growth rate used to be in the 20 plus, and then now it's like almost single digits. But at the same time, if you look at their EPS, it's insane because of all the share buybacks that they're doing. By the way, Novo does share buybacks as well. So I think perception of growth is a big driver of stock prices right now. So from a valuation metric, you have to understand, is your company a growth company or is it a value company? And when companies transition from being growth companies to value companies, that typically means that the stock is going to get re-rated down significantly. Look at Adobe. Look at Salesforce. It's not like they're not growing their top line. It's just not growing at the same pace as it used to, right? But at the same time, they're buying back shares and doing all sorts of things. So, like I said, it's really hard to turn this around right here. And one of the reasons why Palantir was so successful in getting from that $7, $8 to the 180 is because they were able to turn around that deceleration in growth. So, and we could kind of just take a look at that. And that's the thing that was my mistake that I didn't catch on. So if you look right here, the total revenues have always been up and to the right, which is great, but it's not what people care about in the market. It's actually going to be right here, which is this move from 83% growth to 16 to 7, and now the growth rate is accelerated to almost 38% growth. So if you mirror the stock against this, right? Let me just do the, let's see. Shares outstanding. Let me just look at share price. Let let's see, where is it?
And maybe it's under stock price or.
Yeah, just I don't see it. Stock price, common stock, no. Common stock change, no.
Stock price.
Stock price, there you go. Look at that. So they moved this in their revenue stack. So look at that share price appreciation. So it fits perfectly with this acceleration in re-acceleration and growth, which, by the way, for a SaaS company, hard to do, very hard to do, but they've done it successfully. So the question is, can they maintain this growth rate for, a prolonged period of time? And if they're able to, and it kind of keeps curving higher, then the share price will be justified, at least until things get re-rated to the other direction. So, yeah.
And that coincided as well, because a lot of people were always looking at things on a GAAP basis, as we all are aware, right? Palantir does give out a lot of share-based compensation rather than paying their employees absorbent salaries. They do give out a lot, to align their employees with, the company and the goals of the company and everything like that. And so that puts a large drag on the GAAP net income. But if you look at it from how much like operating income the company is actually generating and where that was kind of going, it was like 18 months, probably 6 to 7 quarters before you started having GAAP profitability, that it was inevitable. You were able to see that was going to be the case way before it actually happened. What is that? That's operating margin.
Yeah. So if you look at their operating margins, it went from, in 2020 when they first IPO'd, 2021, from the negative 35s to now 16%. So with any business that's scaling, especially for SaaS, what tends to happen is over time, your employee count goes up, but not by a lot, but your revenues are growing at 30, 40%. So all of that is just generating you more and more margin, right? So now, not only are you growing your revenue, but you're also growing your operating margin. So, that's helping them a lot. They had a little bit of a dip here in 24, but outside of that, the operating margins are just going higher as well. So, and one of the things that I do like about their management, they have committed to trying to keep their employee headcount low, but nowhere does this fit into my picture of justification on a multiple side. So from a share price multiple, it's insane. So I'm staying away from it, but I do have this prediction that eventually these guys will get re-rated down to the 50s. And when it gets to the 50s, I'll buy in again. We'll see what happens. So.
I don't know. I can't talk much about what I saw when I was in New York.
Don't. You don't keep that.
No. I that's all I can really say is I can't talk much. And but what I can say is my head exploded. I mean, I think people know, and I know people may or may not know, I talk a lot on Palantir Weekly in the past, and have guested on that, I guess, I don't know, since 2022, maybe 2023. But I started using Palantir back at UDOC, Undisclosed Oil Company, back in like 2016, 2017 timeframe, and was one of the first commercial customers as they were getting the Foundry platform up and running, at least that I'm aware of. I'm sure there was others that were on there as well, but it was really cool to be able to kind of get my fingers on it. But all I can say is that what took us some certain amount of time took a fraction of the amount of time what they demonstrated to us in New York on the 11th of September. And my head, like a lot of the people that were in the room, other than the Palantir employees, of course, had not ever really utilized the software before. And my mouth was literally on the table. And so everyone was just kind of looking at me and they were like, what? And I was just like, I don't think you guys understood what just happened, but my head just fucking exploded. And everyone is just like, holy shit. And I walked out of there that day and I bought more shares. So as expensive as it is, right? And I'm very convicted that it is obviously from a safety perspective, a very important company from a software perspective, but also I anticipate that many others will catch on many people talk a big game when it comes to AI, digital transformations, etc. They have no idea what's coming or what is already here when it comes to what Palantir can do. But
Well, I'll
anyway,
be waiting patiently to see these products, man. Eventually, we'll
yeah,
see.
yeah, it's interesting. But anyway, I'm curious. We haven't talked about this stock in a while, and somebody actually just
PayPal
brought it up.
or
No,
another one.
we could talk about that one, but I was going to say Dutch Bros is coming into a pretty reasonable valuation. I don't know if you want to pull that one up, or you want me to go on a little spiel before we start
No,
going
bro,
through some of the new news?
I'll pull it up. I'll pull it up. So just one thing before we move on.
Yeah.
So a lot of people, they're always asking, oh, how come PayPal?
Oh, I didn't even
PayPal?
see
And
you pulled up PayPal. I was in my own world. Sorry.
Yeah, no. So this is exactly the story of PayPal. If you look at their revenue growth, it was like solid 20% year over year, kind of accelerated during COVID to 25%. And ever since then, their revenues have basically been flatlining, but their EPS has been going this way, right? Which is exactly what happens. Like they're buying back shares at a breakneck pace. And at some point, that share price is now stabilizing. So guys like Roy are kind of betting on a reversal in fortunes for PayPal, which is understandable. I think if PayPal can keep, reaccelerate this growth, I think they really need to figure out how to grow their underlying business this way. And then that's where people will, like shareholders will see that price appreciation. Now, let me just mention one thing. If you look at this company on a PE basis, right? And
cheap.
this is why their PE, well, it's dirt cheap now, but technically not that dirt cheap. Let me show you why. So if you look right here, let me just hide some of these things. So if you look at the PEs, back when this thing was growing massively, let's bring this up. Look at the PEs that it was having, 106, right? So as long as you're growing your top line, that PE gets justified. But the minute your top line starts to come down, bro, you are a value company and you're going to get re-rated like any other value company that's out there. So traditionally, who has this kind of growth rate with these kinds of margins and share buyback programs? Banks, like traditional banks have very similar profiles. They don't grow that much. They do generate free cash flow. They're able to buy back shares with that free cash flow. Sometimes they pay a dividend. PayPal doesn't do a dividend. So if you look at most banks, banks are like 10 PE, maybe 12, 13. Sometimes if they're growthy, 15, but they're like, low single digits if they're shitty bank, and high double digits if they're really, really like solid neobank like SoFi is. So with that in mind, they're getting rated like a bank. So everyone's like waiting for, hey, PayPal is like the growth story. And I'm like, until they reaccelerate their revenue, just keep that in mind, guys. That's all. So
yeah, I mean, that's been my thought. It's like, because what people have been telling me is, oh, well, they're getting into things that are higher margin. So even if the revenue stays flat and they're moving the revenue from one area to another, but this has higher margin, then I can kind of see what people are saying, but I'm not seeing that really happen as much as people, I think, want to explain. And, I'm optimistic that they are still generating a lot of money and it could be a great buyback play. But I'm with you, Chris. It's kind of like, do I really want to invest in a company strictly for the buybacks? I don't know. It's worked well for AutoZone, but yeah. AutoZone also has grown over the past 20, 25 years their net income by 6x. So,
I mean, look, these guys
coupling that with the buybacks, obviously they that's where you get the 50x return, right? That you've been able to shrink the shares outstanding by 87%. And then, so it's obviously shrunk the shares to 1/8 of what they were. So multiply every share by 8, then multiply, the net income by 6. And if you keep the multiple flat, then of course, that's where you get the 50x return. Is that what's going to happen with PayPal? I don't know.
PayPal should, honestly, PayPal needs to get into the brokerage business. You know what I mean? Like that would work well for them because they already have like inbuilt clients. They have all these things. So I'd say work either buy a neo brokerage like Webull, or I don't think Webull would ever sell to them, but buy a neo brokerage that has some traction and then work on getting people to convert, and then do like all these side hustle businesses like the whole prediction markets and inter what is that thing called, inter account like transfers, you know, and basically bonus it up. And I think that could be a nice growth driver for them, because look, the brokerage business, like I said, I don't think it's going to slow down for the next like 10, 15, 20 years. And I'm sure that it'll get re-rated when the economies, you know, come down. When we have a recession, trading volumes will go down naturally. It's part of things. But I think those are more opportunities to buy the dip rather than fight against the trend. I mean, you're seeing the same thing with like all the other main guys. Like you look at IBKR. This was one of my friends worked at IBKR, and he told me about this in like 2014. I wish I had bought it at the time, but sometimes I am too dogmatic once I said. And if you look at their total revenues, look at that. This is for IBKR. Okay. Look at that revenue growth. Massive.
Mm-hmm.
You know, so let me just pull up. Yeah, and if you look at their EBITDA, same thing, growing massively. So why wouldn't a company like this get a huge bid? So I'm telling you, the brokerage business is one that's driven. And if you look at like the revenue growth, where is it? Revenue growth. It's literally like sitting at 20% and is flatlined here at 20, but it's not going down anymore. It's staying steady. So once you combine these two metrics and you just look at the share price with all the share buybacks and everything else, bam. Look at that. Massive run to $68. So, yeah. Sorry. Let's look at another one if you have something in mind.
No, that's good. I mean, the thought process briefly around Dutch Bros, then I'm curious what if you pull up in the background maybe, but let me just pull up the investor deck really quick. So the kind of thought process around Dutch Bros is obviously the fact that they're going to try to grow total store count between now and the end of 2029 by 2029 stores. So as you can see on the slide here in the upper left, it's just over 1,000 stores. So where they're at compared to where they're going to be between now and 2029 is about half the size, right? So they're going to be able to double pretty much the revenue. Now, what they've been able to demonstrate, and I'm not going to pull up all the different slides and everything like that, what they've been able to demonstrate is even though they are still infilling into certain areas, they're able to maintain a really good AUV, annual unit volume, for each store. So each company operated store, they're generally getting about $2 million per store. And so what you can see here is, yes, there's about 725 stores that are company operated. You obviously multiply that by 2, you get to about 1.2 or 1.4, 1.5 billion in terms of revenue. And what's easy to then say and look at is then, okay, well, their EBITDA margins are actually pretty healthy at 22% and growing. Just a couple years back, they were in the low teens. They've kind of grown into the mid-teens, and now they're getting into the low 20s. And as your SG&A comes down, which is starting to go into the mid-teens and is hopefully going to tail off into the low teens at this point, you're getting to a point where, like you're stating, really starting to see your actual free cash flow for the business start to get good. And that's why when we pull up your graphics, that's why when we pull up your graphics, people will probably notice that mid last year, the stock price really started to move in the right direction, is because they actually started to generate positive free cash. Because the EBITDA really started to show up, and obviously for the past 4 or 5 years they've been in growth mode. They pulled back a little bit on CapEx this year, just because I think there was a concern. I guess they were hearing people talk to, like, we'd rather you pull back a little bit, and get some free cash and not necessarily come out of pocket, go into debt in this high debt environment. And we'd rather then, as you get to a point where you start to generate free cash, then you can expand your capex again to kind of grow how many stores you're opening. So obviously between now and the end of 2029, they're going to open up another about 1,000 stores. And so with that, you think about it, 2,000 or so stores. And I know this is going to be off a little bit because they do obviously have these franchise stores, but hear me out. So 2,000 stores, let's say, and it's not going to be verbatim in 2029 because you have these franchise stores. But let's just say in 2030, 2031, they do actually get to this 2,000 stores of actually company owned and company operated. Got it. So it's about $4 billion or so in revenue at that point, and maybe even more because AUV is actually expanding pretty well. And at that point, with inflation, it might be 2.1, 2.2 million per store. But let's just say for now, $4 billion in revenue. Use the EBITDA adjusted percentage of about 21% or so. That gives you, I'm not very good with math, but about 800 or so million in actual EBITDA. The company right now is worth about 8.5 billion. So if you think about it, that would be a pretty cheap valuation. Of course, now we're talking several years down the road, but if you think about it, what does that mean? Like, and then you start thinking about, well, where does this company terminally going to be? Is there going to be potential for international expansion? Is there going to be for potential for 4,000 stores, 5,000 stores, 6,000 stores? And if you start thinking about that and you say, okay, well, where is the actual adjusted EBITDA going to end up, right? Where do you want it to be? What multiple are you going to put on top of that sort of valuation, right? Are you going to give it a 20x multiple, 25x multiple? And the reason why I'm using EBITDA, by the way, is because there's real estate involved. And with real estate, as you know, there's a lot of depreciation. Yeah. And so it's hard to use net income on something like this because the real estate's involved and it'll actually artificially lower the value, even though you're actually getting a large amount of cash through the business. So actually utilizing cash flow from operations is probably a better thing than EBITDA, but for right now they report EBITDA, so I'll use EBITDA. So you think about it, let's just say they do get to 4,000 company operated stores. Let's just say $2 million per AUV again. So that's 8 billion in revenue. So 8 billion, once again, we'll use this 21% EBITDA. I think it's probably going to be closer to 25% by the time you get to that place. But so let's just say it is 21%. That gives you 1.6 billion in EBITDA. What multiple are you going to put on that, Chris? Are you going to put a 20, 25x multiple on that? So multiply 1.6 by 20, multiply 1.6 by 25. And what's the market cap of that? Right now, you're at an $8 billion market cap. At that point, you're approaching something that's getting close to the mid 30s to the 40s. And so you start to understand as this company gets big, and they haven't even started really selling food yet, and they're starting to monetize that and come up with plans to be able to do the food piece about it. Is that going to expand more?
Sorry to interrupt, but how can they do that? I mean, I've been to their locations. They pride themselves on being really small. They have like very, very small footprint. So how would they incorporate food into
It's going to be like really ready-made stuff. There's only going to be 6 SKUs, right?
Got it.
So right now they have 4 SKUs. And if you ask, it's like 3 different muffin tops and a granola bar, which are all really good, by the way. The granola bar is the best granola bar I've ever had. But then I think they're going to shrink it to 1 muffin top, just a chocolate chip, a blueberry muffin, like a chorizo wrap, 2 different types of sliders, and like a loaf of banana bread or something like that. All like pretty pre-made stuff. So that way you're not like cooking. You don't have a fryer. You don't have anything like that. And the hope is that like what they're looking at, and if you look in the investor deck, I should pull it up, but I'm lazy. Yeah. But in the investor deck, what they're seeing is that most of these coffee shops that are out there, sell way more in the morning. Dutch
Hmm.
Bros actually sells more
Throughout the day.
throughout the day than they do in the morning. So their hope is that if they introduce food, they can almost sell it as a loss leader to get more people to drive. Because you're seeing, if you look at it, the gross profit on the drinks is already 30%. And so it's like, well, if you just get another drink, you already have the people there. Then you're just focusing on making sure that you get the throughput, and you're also making sure that you get an extra drink throughout the day. Then if you think about it in that perspective, your potentially gross profit can get a little bit better. Your EBITDA margins can get a little bit better. Your AUV can get a little bit better. And so I don't know, man. I look at this and I'm like, interesting. I can see a spot here where the early 2030s, this stock can be, and this doesn't include buybacks or anything like that. And it does include a little bit of share dilution, because I think that's just inevitable with companies like this. I'm thinking low 100s to $130 a share by like 2031. And so obviously you're not gonna retire tomorrow.
Next year.
Yeah. But if you're looking for a spot where you're like, easy business to understand, they're growing, I can track this quarterly to make sure things are in the right direction. I see the potential. I see where Matt's head is at. I can see from here to here. I can track that steadiness, and I understand where Matt's math is at, and I agree with that math. Then to me, I'm like, shit, I wasn't going to buy when it was back at $80 a share, but now that it's back down to 50, I'm like, maybe I should. And my hope is eventually that you're not going to just throw money forever into opening stores. Eventually, my hope is that you eventually do buybacks, dividends, etc. And so my hope is
I don't know about that one. I think that for them, they're so small, they don't really need to focus on that piece just yet. Like
I'm talking like 5-10 years down the road.
Oh yeah.
I'm not talking tomorrow.
Sure, yeah.
No. Chris, you know me, man. I don't
you don't
buy these things.
You don't look in the 2 to 3 year time frame. You look at 10, 15 years.
Yeah. People are like, Matt, I can't believe you're talking about Palantir buying dividends. I'm like, I'm talking about 2035 plus, my guy. When they're making like $15 billion in net operating income, when they don't have anything to spend money on today and they have $6 billion of cash, right? Yeah. So people like to give me shit and they're like, I never want them to, it's like, but what are they going to do with the dividends? What are they going to do? Or what are they going to do with all the cash? Right? Yeah. Buy back stock or whatever. I mean, you have to think eventually a lot of this stuff is going to be a reality.
Yeah. I think so. Yeah. It's funny. Heinz's like at Chris's wing play in 2022 was epic. Yeah, that was a really good one. Wingstop was just, bro, the price of wings had gone up temporarily, but you could see like the life cycle of the chickens was so short that there was like a new batch coming, and that was going to lower their margins. Lower the cost. And so like Wingstop went up and to the right. That was good. But let's take a look at Dutch Bros right now. And I found some interesting things. So this is Dutch Bros' share price. Let me just actually bring this down a little bit so that this was easier to see. So you can see it stayed pretty much flatlined around here in the $30 range post IPO, and then kind of had its moment of growth where it actually went all the way to 85 and kind of traced back down to 52. If you just look at their total revenues, because they're opening more stores, it's been doing well. So let me just bring that up. Sorry, that's revenue growth. Let me just pull up total revenues right here. So you can see their total revenues have been kind of up and to the right, which is always a good thing to see. Most businesses in this category are going to be up and to the right businesses. The more stores you open, more revenues equals more stores, blah, 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 right? Until you're fully scaled up, you're not going to be a value play. This is clearly a growth play. So the more and more revenue goes up, the better off you're going to be. And you can see that in the revenue changes. The one thing I like about this company right now is just that their revenue growth has come down, but it's literally like at 30% year over year. Not very much. Like, it's not like, oh my God, going down to like the 20s and the teens, right? It's literally staying at about 30%. So even with the higher higher law of big numbers coming into fold, they're still able to maintain a decent growth rate of about 30%. If you look, 30% revenue growth compounded is absolutely monster. And at the same time, they're actually improving their operating margins as well. So they're right here. You can see their, let me just bring up their, close this thing. So their operating margins over time have gone from negative when it first IPO'd, like negative 21%, to now almost 9.2%. So as you scale up, that business is going to become more and more profitable. Why? You only need one HR department. You only need a few people doing marketing for the entire brand. So the more stores you add, but their fixed costs are going to kind of, they're going to go up, but they're not going to go up at the same pace. So your profitability is going to keep going higher. So profitability is growing for these guys. The revenue is getting higher, which is always good to see. And then if you look at their operating margins, which is where companies, EPS, you can see their EPS right here. And let me bring it on another axis so it's easier to see. EPS, no, sorry, not this. There you go. So its EPS went from negative 4 cents to now about 50 cents per share. Still really high in terms of like, PE for a food services company. But you got to remember, this is a growing food services company. This is not a mature business like Starbucks. Starbucks is so mature, they're running out of locations to put more things because they're so saturated. And now, because they're so big, they're sort of getting into like these sort of troubles with unionization and all these other things. So, by the way, Starbucks has also is trying to do more where they capture more value throughout the day. Because right now, if you go to like even my local Starbucks, in the morning time, it's a fucking madhouse. But then if you go around like 11, 12, barely anyone there, right? And one of the things, I was actually talking to some of the employees at Starbucks, and they're like, we hate working for Starbucks for not because of the pay. They hate it because they don't get full-time work, because the thing is, Starbucks has a lot of shift work and part-time workers. And so what happens is they'll be like, okay, so come for this shift. And it's like the busiest part of the day, right? That they're there for. And then the rest of the day, there's not much to do. So you don't need that full crew there. Now, could you work a job and survive off of working 4 hours a day or 5 hours a day? Like, no, you kind of need that 8-hour continuous shift to work. So a lot of them are, trying to advocate for that. But the thing is, that business model may not work for the coffee shop thing. So like I said, in the morning time, you need like a crew of fucking 5 to 7 people just to manage the demand that's going to these places. But then in the afternoon, you only need maybe 2 people, one person to cover the drive-through, another person to cover the inside clients. And maybe one other person to do like the inside drinks. I mean, I don't know. So they got to figure out how to get more people to come in during the afternoon times to justify having more full-time employees throughout the day. And I've seen some of the stuff that they do, and like they do like refreshers, during the summertime. The refreshers work where people come in. It's like carbonated, teas and all this other stuff. But yeah, so I think Dutch Bros is doing it right. They're being smart, saying, look, if we can generate business throughout the day, we can kind of keep our workers happy as well. And yeah, like, have you noticed that about your local Dutch Bros? Like, where when you go in the afternoon, is it just as busy as it is in the morning time?
Yeah, pretty much. I think it's funny. People are like, oh, Starbucks is going to eat their lunch. It's like, you realize that they're both coming out of the Northwest part of the United States, right? And
yeah.
Dutch Bros is expanding like crazy, 30% revenue growth, like really not getting here. And I heard the same thing, McDonald's Cosmix is going to destroy Dutch Bros, man. And they're opening up in Florida. And I literally just like went to go to get some boneless chicken wings the other day, and another one opened up literally like right down the street from me in a different direction, like always, and still full. Like, so Starbucks, as much as you would like to think, I think people are tired of that particular brand. Maybe this is a fad and maybe people, but it's a different type of coffee. If you want something that's more burnt flavored, then Starbucks is great. But if you want something that has a little bit more dairy and or energy focused, like energy drinks, etc., maybe some more tea focused or sodas focused, then Dutch Bros is going to be your kind of thing to go. But they don't have coffee per se; it's more espresso. So that's another piece of it as well. So it really just depends on people's flavor profiles. But yeah, there's that. But I think it's pretty funny how people are like, "Oh, Dutch Bros is going to zero. Starbucks is going to eat their lunch." It's like, well, how come they've been around for the same amount of time since like the 90s, and Dutch Bros hasn't gone to zero yet.
Yeah. I mean, if you look at another one that's like that is like CMG, Chipotle. Chipotle has really lost a lot of the like same sales store count is down, but look at this drop off in revenue growth, bro. It's insane. So let me just pull this up 1 second. So if you look at this spike, of course, this is the one thing that COVID's ruined for me. A lot of the chart features that I have, like anytime I look at it, that giant COVID up and down move, anytime I look at a year-over-year basis, it screws things up. And I'm like, how do I get the software to just ignore that COVID time frame? Because then it looks relatively like different. So like this 21% to 8.6% revenue growth, it's a significant decline. But because of this stupid COVID spike, it looks like, oh, it's not really that big of a deal. I mean, it's just from a visual standpoint. So
yeah, I guess you could shrink. Yeah, you could shrink that.
Yeah. They have to shrink it down, but it's not, like I said, I would rather just see a straight line thing. But you can see here, post 2021, they're growing at 26% year-over-year revenue growth. Now it's down to like 8.6. So Chipotle has some problems ahead of them, man. So a lot of people are like, oh, Chipotle is a value company, and I think they're doing good. This is basic. Let me do diluted EPS. If you look at their diluted EPS now, that's starting to kind of flatline too. So Chipotle used to get a huge valuation premium
multiple before, yeah,
and now it's not. So if you look at the ratios, let me just pull up the PE on this thing. Look at that. Look at that PE. Literally went from 91 PE now down to like 35, which for an 8% year-over-year growth rate. Yeah. So this is a value trap right here.
It might still come down for sure.
What's interesting is I did a poll on X real quick. Let me just bring it up about Chipotle to see if people were trying to get this. And sorry guys, I have to just search for that poll. Damn it, did I not search CMG Chipotle? I think it's right here. Yeah, look at this. Look at this poll. So I just said, you know what? Let me just ask a very general poll. Do you eat more, same as always, or eat less? Some people are like, oh, like define the time frame. I'm like, nah, I left it intentionally vague just to get like raw sentiment. And bro, 62% people say they eat less at Chipotle than they did before. So there's something definitely wrong over there. I don't think it's purely just, hey, like, I don't know what it is, but dude, that is
I think it's options, right? I mean, you have other things like you have Kava, you have, you know what I mean? Like it was like Subway, right? Subway used to be the shit. And yes, there is a piece about, and I've had this debate, so I'd love to get your thoughts and people in the chat, of course, as well. But like Subway when I was in high school was the fucking shit. Like you couldn't get anything better than Subway. Yes, the quality was better. Yes, they did. There were some things that obviously deteriorated the quality, but at the same time, Subway was the only game in town. That was the only really fast casual restaurant at the time, other than normal fast food like Subway or like McDonald's, Wendy's, Burger King, and stuff like that. So when Chipotle came out, it blew my fucking mind because I had another option. And I love Chipotle. Now they've come out with some like stuff like Salada and Kava and all these other things that are also fast casual that really allow you to expand on that sort of business model and keep ingredients somewhat fresh and fast. And so to me, it's really gotten more competitive, where Chipotle really was able to take advantage of a certain amount of time. I hope it doesn't turn into a Subway sort of situation, but at the same time, quality has gotten worse every time. Like, I get a bowl from Chipotle, it used to be like steamy hot. Now it's like lukewarm. And I thought that was the problem that got them in trouble in the first place, because of the E. coli stuff that was going around back 7-8 years ago. So it's like the fact that I'm getting like cold meat in my like bowl, it's like, it doesn't make any sense.
You know, I have a suspicion on what it is, and I think it could actually be impacting food, like restaurants in general. Not all the restaurants, but a lot of these fast casual places. This was shocking to me. Let me just show you real quick. This right here. This was a chart for people with obesity in the United States. So if you look at the trend from 2010, it's literally was on the up, like the giant incline up to about 2021, 2022. This is the same year that Ozempic got introduced. And look at this move down on severe obesity and also obesity in general. So there could be something along, and I think about last time I checked, there's about 2 to 3 million people in the United States that are on some form of GLP. Now, the thing with GLP-1 medications is that when you take them, it literally like just diminishes your appetite like crazy and you start losing weight. But there's so many people on these things. I think it's actually finally starting to bend the curve on people going out and eating a lot of these fast casual places where people were just going there. But that's crazy decline. I mean, this is good for overall health for, you know, for the entire country, of course. But look at that drop off. It's kind of massive, right? And this is one of the reasons why I'm kind of bullish on all the GLP-1s. Like if you look at Eli Lilly is just up today because they've got the number one, in my opinion, the most effective GLP-1 medication, which is Mounjaro right now. And there's more that are coming. So Novo Nordisk has oral coming. Eli Lilly has an oral coming. And I think those are going to be growth drivers where it's going to open up access to a lot more people going into the future. So, you know, maybe food the fast casual food business, just from a macro lens, may not be the best place to be. Because if a lot less people are going to fast casual, one, because it's probably more expensive these days because operating costs are expanding rapidly because of employees and everything else. And then you have obesity rates going down. And then immigration, by the way, that's the other thing. Immigration rates are coming down as well, right? So you've got literally, you're losing 2 million people around the country. Like right now, according to DHS. So what is that going to do for a food retailer? I mean, whether you're an illegal or you're a citizen, you're eating food. So if you're losing customers and you've got this massive community of people that are no longer, you know, eating at your place anymore because of one of those 3 reasons, not exactly a place you want to be, right?
I'm curious, did the margins at least go up? Like the operating margins go up for Chipotle?
No. Let me just pull it up real quick.
And I'm curious about like McDonald's in them as well, because was it last week or what? Maybe it was on a different stream where we were chatting about how McDonald's is like 200% up versus 100% up for inflation or something like that.
Let's do operating margins real quick. Income, operating margins. They're same, from what I know, just from like a bird's eye view, their same store sales have been on the decline. So operating margin right here. Operating margin. Okay, so let me just hide some of these other operating margins. Yeah, look at this. Operating margins are starting to kind of decline a little bit. So they've flatlined. Literally, they've been stuck at 17, and last quarter it's like 16.6. So now you've got declining revenue growth rates. You've got declining margins as well. Probably not the best place to be, you know? Yeah. So yeah, this is the time where you got to be careful because a lot of these things are value traps, you know. And
what about McDonald's and like Wendy's and them? Are their operating margins decreasing? Because they've been this McDonald's is the worst. Like they've just completely skyrocketed shit. I would be surprised if their operating margins have come down. If anything, they should be expanding like fucking insane.
Well, remember, operating for these guys, for McDonald's, their operating margins are flat. But remember, they generate so much.
Oh, real estate. That's right.
They're not like whether you go to McDonald's or not, they don't make money on that. They make their money on the lessees. So they own, if you saw the movie, and this is a movie, by the way, everyone, if you want a crash course on how businesses work, and it's a really good movie, watch The Founder with Ray Kroc, and how basically he took this business idea from these two brothers, the McDonald brothers, and then turned it into the McDonald's that we have today. But, McDonald's is a real estate holding company. They're not impacted by the other part. So they're maintaining their margins. The question is, their revenues are probably not growing that much. Yeah. See? So look at their revenue. Their revenues are barely growing 1.2% because they're hit saturation point. This is like any other REIT. How much can you actually raise on the lessees? Not much, right? So most of their earnings is going to come from probably their share buybacks. So if you look at their diluted EPS is growing. Sorry, let me just pull this away. So their diluted EPS has been stagnant, but it's growing a little bit, right, to about 11.7%, primarily from probably share buybacks. So let's take a look at their cash flow statement. And net income is there, cash from operations, share buybacks, repayment, net issuance, repurchases. There we go. Yeah, look at that. Even their buybacks have kind of been not that great. So, yeah. Let's take a look at the share count. Share count. Diluted share count outstanding. Yeah, look at that share count. It's pretty much flat. Let me just hide some of this other stuff. The line chart. Yeah. You see that? So most of their growth has been coming from their EPS basically is flat, and they're just buying back shares. So it went from 751 to 718 million shares outstanding. I think they also have a dividend too.
They do. Yeah, pretty good dividend. I think they're they're a dividend king. I think close to it.
Let's take a look at what their dividend is. Let me just hide all this other shit.
For this person that's asking, yes, we do stream on YouTube for cash. It's under CASHFLOW Chronicles TV.
Right here, dividend. Right. So that's the total dollar amount that they do in dividends. I don't need that. I need dividend yield. There you go. So remember, the dividend yield is going to be based on the share price, right? So the yields it's not like they change their dividend yields every single year. They're like, oh yeah, today we're going to pay, 3% or that. It's just if the share prices adjust up and down, your dividend yield is going to change. So the dividend yield right now is about 2.3%. I wouldn't say that's great considering with treasuries, you're getting like 4.25%. Like SGov gives you 4.25%, and if you're a non-growing business, I'm not sure McDonald's is really the place you want to park too much cash. But it doesn't seem appetizing. Like McDonald's doesn't seem appetizing to me, especially with all the macro headwinds from the other stuff that I just said. So, yeah. Yeah,
Doug, I wanted to thank you. I forgot. Yeah, Michael Keane does a good job on that one. Phenomenal job in that movie. Doug, thank you for the 5-member earlier too. I forgot to say thank you. Much appreciated, brother. Much appreciated. This is an interesting one. I would love to get your thoughts on this comment here, Mr. Patel.
Dude, if the milkman invites me, I'll come on. I love Steven, man. Me and the milkman, we talk semi-regularly. Like, usually me and him, usually what we do is we call each other on Saturday and just like, can you fucking believe? Because, Steven curses. If you think I have a potty mouth, Steven is worse than me, dude. He'll be like, can you fucking believe what Carp just said? And I'm like, bro, your calls are underwater. I get it. So me and him, we have this.
I get it.
we have a bonding thing between the two of us where I sold really early and he sold too many covered calls and he's been rolling them forward for like an eternity now. So he's way underwater. So we both have a vested interest in Palantir going down. So we bond over that,
Yeah. I think we need to have silly question. Because I didn't see the stream as of yet. Sorry, I'm not showing the comments on the stream. Sorry, everyone. I heard that Mr. Fiorillo is starting to get into next decade, and I'm curious if you've had a conversation with him about it or not.
I haven't.
No? Interesting. No. So I think he went on to somebody messaged me and said that he went on to midstream and said he started to potentially look at it. I don't know if he actually bought it or not. So I'd be curious if he's done his analysis. I'd love to get him on because I know a lot of people. It's 11:30 at night. No, we're not going to call Steve.
He's got a wife. I'm not going to do that to him.
He's got a real boss. Unlike me, I can do whatever the hell I want. But within reason, of course. But yeah, I still haven't asked him. Every time I talk to him, I keep forgetting to ask him.
So one thing about the comment section, guys, when I like simul stream to Twitter because I kind of want us to grow this channel. If you haven't, by the way, we're on YouTube. I think Zoe put a link in the description. If you want to check us out on YouTube, please check us out and subscribe so you always get alerted. But I can't comment on like the chat. Like before I would able to be comments, I can comment on YouTube and you would see my comments appear on there as well, but I can't comment. So I don't know if you want to take some questions from in there. I think I saw one really good one about CCL, about like the cruise lines, why they've been down. CCL. No, I saw it on here on the comment section. So cruise lines, CCL has kind of taken a little bit of a dip. A combination, they really had a really, really strong quarter. This is not up to date, by the way. They had a really, really strong quarter, but they also in their guidance, they mentioned that they were going to have some headwinds next year. And the reason why they're going to have some headwinds is because they're investing in some of their some of their secondary projects that they have. But in terms of where this business is headed, it's doing really good. Like net yields, which is higher than what they guided for last quarter. Net income is about $2 billion now. Adjusted earnings on a diluted basis for Q3 is $1.43, which is their strongest quarter. So if you look at it on a full year basis, they went from $1.70 guidance last December to $2.14 this in September. So huge improvements here. Net income is also growing, which is always good. So this business is in recovery mode. The one downside that they have is they don't have much in terms of additional ships right now. So if you look in 2026, they have no additional ships coming online, which means their top line growth is not going to be growing nearly as much. The reason why is because they're focused on delevering right now. So their goal is basically going from the current rate. Like if you see this, they went from like literally double B to now double A, BA positive in Q3 because they're getting their net leverage ratio down. So they're in the process of paying off a lot of debt. That means that they're not investing as much money in growth CapEx, which is fine, because as a shareholder, you kind of want to make sure that the company you're invested in is going to give you those tangible returns. So next year, they're projected to grow, but it's not going to be based on additional like 6 to 7% in capacity. What they're essentially doing is doing margin improvement, which is good for their business, right? Long term. So 2026 may be somewhat of a weaker year in terms of top line and bottom line growth. But it also, in my opinion, it's probably because they're giving themselves enough room to outperform next year, right? So from an absolute valuation standpoint, there's not a lot of upside for Carnival right now. And what's interesting is if you pull up our what is it called? Our portfolio, I asked you to sell before earnings because I suspected that they were going to, because they had kind of like already announced that they were looking to do a lot more in terms of reducing down their their expenses and increase their EBITDA. Well, not EBITDA. Well, basically, reduce down their debts. Their EV to EBITDA would expand, right? So that's what shareholder value is. So the target for this is $35 by the end of 2026 for me. So my thinking is, it was already at 31, 32. Like, do I really want to stay in this with a 10% upside? Probably not. You know, we're somewhat growth people. So, but yeah, CCL, this was a great move, man. Great move. At least for me, it was a great move because I did spreads on these guys, and you know, whoever was in it with me, we did well. So,
were we supposed to sell Norwegian or no?
No, leave Norwegian because unlike Carnival, Norwegian
is investing through the cycle. Yeah.
Right. So what they did was they focused.
That's like, what Shell does, by the way. So I shouldn't say this shit out loud, but too late. Shell does that. So and Exxon does it really well as well. They invest through the cycle, even in downturns and when oil price is bad. And the nice thing is that when the environment gets good again, like you're stating here, and what you'll probably talk about is like that means your top line is going to be phenomenal, right? So you can, if you can afford it to eat shit in the bad times, then you're going to live like a king during the great times.
So unlike Carnival, who kind of dialed back their shipbuilding program, Norwegian took the hit and just said, you know what, even if it means from a share price appreciation we won't get as much, we're going to invest hard in getting additional ships online so that this way a growth profile is there. So if you look at the net leverage on Norwegian, net leverage kind of stayed around that 5x on an EBITDA basis. So look at Carnival. Carnival went from 5 to like 3.4 because they didn't order a lot of ships ahead of time, right? They focused on delevering, which is good. You know, that's kind of what you want to see for value creation for shareholders. Norwegian said, screw that shit. We're going to keep building these ships because these ships you have to build like 3-4 years ahead of time. And so they have more ships coming online. So next year they're focusing on delevering, which is good because, you know, you kind of want to delever. But Norwegian has two things going for it. Number one, interest rates are coming down. And two, they're delevering at the right time. So if you look at their net leverage, it went from 7.3 to like they're guiding for mid 4s. And if you look at their adjusted EPS for 2026, it's literally growing at 20% next year. So their EPS is going to be about $2.45, what they're guiding for next year. Usually a company like this gets about a 15 multiple, roughly, you know, sometimes a little 13-ish. So if you do like just a raw number in your head, $2.45, let me just do a calculator because I'm slow. 2.45 times 15, you're looking at a $36 price target, right? So right now the stock is trading at $24. So you can see that that's a 30% upside. So that's why you sell Carnival at 31, 32, but you keep Norwegian at 24, 25 because you can see the upside is on Norwegian side. So they're both going to end up probably at $35 or close to $35. But from a valuation perspective, which one do you want to go with? I would say right now, Norwegian is the better play. So,
I thought it was funny. Somebody said Carnival seems to always have fights and brawls for some reason. I lost it.
That's entertainment, bro. That's the entertainment.
That's what you're paying for, you know?
Yeah.
Oh, man.
Yeah, so you can see here that from their shipbuilding program, they have, sorry, let me just bring this up. So you can see here that they have 2 ships coming online, and they have one in Q1. They just launched one not too long ago. So they have one coming in like right here, and then Q4, and then they have 2 more ships coming, and then 28, they have only one. but you can see here that they have a much more stacked lineup in terms of total capacity growth. And so just this one ship right here, like the Norwegian Luna, is going to increase their berths by a good percentage, so. And you can see here, same thing. So capacity growth is on Norwegian side. The other thing that's really big booster for the cruise line industry in general is actually low oil prices. So much of their net margin gets impacted by high and low fuel. So you can see here from fuel consumption standpoint, as long as your costs remain lower, like right here, it benefits your earnings. And because this is like a thinner margin business, if you can have oil bunker rates at $50, $60 for a prolonged period of time, you're going to do good. You're going to do real good. And they hedge, by the way, too. So they make sure that when oil prices are low, they're able to, basically buy this fuel ahead of time, so that this way, if let's say prices spike for whatever reason, they're not going to be impacted. Because remember, they have to do advanced ticket sales. So these companies, what they do is they sell tickets a year, sometimes 2 years ahead of time. Well, not two, but like a year and a half ahead of time. So how can you price something a year and a half, but you don't know the price of, the price of oil a year ahead of time? So you have to kind of make that decision. And sometimes you get caught on the wrong side of that. You could hurt your shareholders a lot. That typically is one of the biggest problems with the airline industry. The airline industry has these spikes where they have to sell tickets, but they usually sell them 3 to 4 or 5 months at a time. And so if the price of oil, like jet fuel, just randomly skyrockets because a refinery in Jersey goes down, all of a sudden now they're gonna, for the next 2 quarters, they're fucked. So they tend to also hedge their bets. The problem that they run into, though, and this is the same thing with most industries, the hedges sometimes work against them. So if you look at Southwest, when oil prices were at $80, they bought a whole bunch of futures contracts for $80 jet fuel. And then the price of oil went down to like 60. So now all those hedges are basically screwed, right? And the thing is, you bought that oil ahead of time, so you're thinking, hey, I'm playing this smart. But in actuality, you're compressing your margins significantly compared to your competitors. So now your competitors are buying at 60 and your margins get screwed over. So, so I don't like the airline industry for that reason. The airline industry is probably the worst industry to ever invest in. So whenever I see any portfolios with airlines, I'm just like, hell no, not doing that. Yeah.
Good point. Well, we're at an hour 30 almost. People are asking, do we want to talk about next? Do we want to talk about VG? I think that might be a different topic for a different day. We've
beat Next to death. We beat Venture Global to death, man. Y'all, guys, it's a long-term investment. Just chill. I don't know. There's not really much in terms of day-to-day up and down. I mean, other than that, gas prices kind of just going up and down. I mean, I told you it's the widowmaker, right? But if you're holding Next Decade or Venture Global and you're looking only a year or two ahead, that's not what you want to be investing in. Okay. Yeah. If you don't have the patience for the next 5 years, you might as well just sell them and buy something that's more undervalued right now that has a better growth profile. This is like farming, right? You're not planting potatoes that are going to be in season in 3 months. You're literally planting a tree that's not going to fruit for the next 5 years, right? Yeah. But when the fruits come, you're going to make a ton of money, right? So if your investing style is growing potatoes, Next Decade, Venture Global, probably not for you. If you're investing for fruit trees, be in it. By the way, that analogy comes from my dad. There's a really cool saying about trees that I really like. It's a really good quote. Men plant trees that they know they'll never get to eat the fruit. You ever heard of that before? Like that's what men do. Yeah. Like men, we tend to invest and do things for the next generation, but y'all don't know it. you know?
Mm.
So, yeah.
Now you know. What I was gonna say is, and I was having this conversation the other day because like somebody will just ask me something like, Matt, like, are you buying this? Are you buying that? It's like, well, I don't personally feel the need to buy every stock that everyone else is, right? And that's just a me thing, right? And that could be that that could be a mistake or not, right? But I don't feel the need to FOMO into something unless I truly see it as a good opportunity. And so I encourage people, buy something because you actually see it aligning with your portfolio and your goals. And it brings me to my second point is like somebody was just like, Matt, oil prices are low right now. I know that you're buying oil stocks. Like, should I be buying X? Should I be buying Y? I know you have that in your portfolio. And it's like, I might be buying oil stocks for a completely different reason than you are, right? Oil stocks, I'm not buying those because I think they're going to 10X or 20X. Like I'm not, and I don't know if I really disclose what oil stocks I'm buying or not. So I have to double check whether or not I am, but I'm buying some like small, no name, not no name, obviously they have a name because they're publicly traded, but they're smaller stocks that probably people have never really heard of. And I'm mostly buying them for a likely acquisition target or long-term dividend appreciation in the long term. And I see that they're extremely undervalued comparatively to what other people are trading for, the Oxys of the world and many of the other larger oil and gas companies. So my thought process is, well, that means one, they're in good financial standing, and I've scouted them out. And if the market does decide to go in the other direction, then it could be a good opportunity where they can grow dividends and things of the like. And that's why I'm buying them, not because I think it's going to be like a next decade, which I think is going to be multiple returns, right? Versus like, I mean, I'm not really buying next decade for the dividends, even though I know it will come. I'm buying it for the fact that it's going to turn a lump sum into money into many more piles of money that I hope to kind of take off the table. Maybe I won't. Who knows? Depends on the yields. But it just goes to show that, you have to recognize like what are you actually investing in? Like if you're not into crypto, don't chase everyone into BMNR, right? It just doesn't make sense, right? And not saying positive or negative against BMNR. I'm just using it as an example, right? If you're against smoking, like, and I start buying like vape stocks, you know what I mean? Like, it just doesn't make sense. So I think it always just goes back to trying to understand what your objectives and time horizon and everything associated with your portfolio. And that's not to say that has to stay static, right? That's dynamic, just like everything. And sometimes when the market's hot, you have to lean in, somebody have to lean out. But I think sometimes, unfortunately, people will just say, hey, Matt's 34. He's got a couple M's under his belt. I'm just going to buy whatever the fuck he does. And it's like, I don't think that that's the right strategy. I can take on different risks because of, what I've done. And I also have a good, paying job and things like that have allotted me that. But so you just have to think, your strategy and your investment decisions are yours, and they may, as a Venn diagram, coincide with mine, but that's not always the case, right? You could be sitting there as a 65-year-old gentleman or a widow and, be looking to make sure that you're conserving money. And you might have the opportunity to invest in strictly just a money market fund and have all the money that you need. And unfortunately, you might put it into something like that, like a space stock or something like that you saw on the internet, and lose half of that. And now you have to, unfortunately, go back to work. So it just goes to show you, like, you really have to think about some of these things and not just blindly follow people. And that's the reason why, like, I saw some people saying, Chris, why are you talking about PE? PE matters and it doesn't matter, right? Mm-hmm. It depends on what context you're using it in. And for me, when I look at PE, like, I'm looking at PE in a long-term sense, right? I'm looking at it when stocks kind of hit their terminal end game, right? And so was I putting a PE valuation on Palantir when it wasn't even making a gap net income? No. What I was looking at for Palantir was I think it's going to be, XYZ because I think it can generate XY sort of Z value. And obviously it's blown past that expectations, and we're literally 5 years to the day on from when I purchased my first Palantir shares. So shout out to people that invested direct listing day. But anyway, I just wanted to keep people like on the toes, and I feel bad because I think some people think I'm like lecturing, but I think sometimes people need to be brought back to reality because they think that when times like this where you literally have hot hand syndrome, people think they can do absolutely no wrong. They think there's no crypto winter coming. They think that there's like no end in sight. And in reality, margins are expansive right now. And there's more likelihood that they're going to contract than they are going to continue to expand unless, and this is something that's possible as well, there's some massive efficiency gains with AI or something like that we're just not baking into the plan. And that's always possible. This market run has lasted way longer than I expected it to, but it's not to say that it's going to continue. So
That's what they call
I just
it,
want to
the
make
most-
sure people have a little bit of a reality check a little bit.
That's why everyone's calling it like one of the most hated rallies, right? And the thing is, usually when you see this happen, it screams like, oh, we're at some level of a market top. So take a look at this. This is the Shiller PE ratio. So you can see historically the highest it ever was in 1999 in November. Right now, the market is screaming at a 40 PE ratio, which is insane. But, and here's the caveat: if you look at this on a forward basis, forward PE ratio SP 500. I hope my power's not going on. I just saw a blink. It's not as bad as it was in 2021 just yet. It's high right now in 2021. I mean, in 2020 it was 27. So remember when we had that whole move down right here? Sorry, right here was around 23. So that's where we are right now. If you look at the tech bubble, let me just do. Sorry, damn it. The tech bubble was like 40 something. Damn it, it's not
on a forward basis.
On a forward basis. So
interesting.
Let me see. Historical. Because the thing is, like right now, if you look at damn it. I need all. Give me everything.
Mm-hmm.
Damn it. 90-year chart. No, but this is like, by the way, whenever you see this spike, like valuations didn't go insane in 2009. Which what happened was earnings dropped off a cliff. So all the PEs, that's the thing about PE, by the way, that people have to understand. When the PE spikes like that, a lot of reason was because the share price goes down so much, and then earnings at the same time from a business standpoint go negative to low, right? So basically, if your earnings went from $1 to 10 cents, but your stock price just went down by 50%, your PE just absolutely exploded. So you're like, oh my God, everything is overvalued. No, it's not. It's just you had that 2009 cataclysmic event that caused earnings to just dip significantly. But right here, about 46 is what it was in 2021, like 2020-ish, like around 40 here. I saw a chart with forward PE that went back, and it was much higher in 2020. Okay, there it is. The standard deviation right here. So, okay. So if you look at on a forward basis, this is forward basis right here. Forward basis in 2020, right? The PE had climbed all the way here.
I mean,
to like 2000s, yeah. So this sharp rise in PE around here. So I have to double check that actually. I think that was the recession. So I think the bubble might have popped around here. This chart is not really good to look at. But basically stocks went down, but at the same time PEs kind of collapsed at the time. So that's why we had that move here. But yeah, it was much higher than what it is today, basically. So I'm not saying that, hey, this isn't a time where you shouldn't be cautious. I think people should be cautious right now because whenever you see these spikes, it's usually not the greatest of signs. But at the same time, I don't think it's something that we have to like, oh my God, everything is on fire, let's sell everything kind of situation. And also at the same time, if you just look at concentration in Mag 7, the concentration has basically gone insane. So right now with the S&P 500, 32% of the S&P 500 is pretty much coming from 7-8 companies. And all of them are just super profitable companies with crazy margins. So the price to sales is absolutely exploded. But look at the margins. Okay, right here, forward PEs. The forward PE is about a 30. So this is kind of dragging the entire S&P 500 ahead. So if you just took away the Mag 8 companies, the PE on the S&P would be about 19, which isn't like, oh my God, expensive, right? So this is where I think the index people are going to get crushed. And let me explain in a minute, but look at this forward profit margin on the Mag 8 versus the regular S&P. The regular S&P outside of these guys is about 12, which is naturally what's there. And this is not including the cuts that we're about to get in interest rates. Interest rates, when they get cut, margins and what are they called? And the multiples will expand. So this
look what happened. A prime example is right after 2020.
Yeah.
Right. Yeah. It dipped down and then obviously expanded. Well, partly probably from everyone recovering as well. But
yeah. So profit margins are pretty healthy right now. Same thing with even outside of the Mag 7, profit margins are, they're not grossly out of line, but they're doing well. The only thing that we have to watch out for as investors is if there's any indication that some of the leaders here get crushed, like Nvidia. If Nvidia starts to move down, then we got a problem, because Nvidia makes up such a big portion of the index now because of just the sheer dominance in Nvidia share price appreciation. So if there's any indication that Nvidia's growth is slowing down, that could be a major driver of, let's say, 50% retracement in Nvidia. And with it, the AI bubble stock, I don't want to call it the AI bubble stock, but the AI stocks is going to, so something to watch out for. And same thing with Tesla. Tesla is trading at such a high premium right now. And at the same time, they make up a decent chunk of the S&P 500. So all these index bros, I feel like they're the ones that are really going to get like smashed. What do you think?
I don't know.
No,
it's a good piece. I mean, I'm trying to understand a little bit more. I mean, you have some value in the like the Microsofts of the world that are a little bit maybe pricey, the Teslas, Apple, but you still have like the Metas, the Amazons, the Googles that I don't actually think are trading that expensively. So
let me just pull up the forward PEs on all of these guys. 1 second, sorry. Yeah. Performance, because they had them. Okay, forward profit margins. Right here. So forward P. No, damn it. There's like one that shows like a chart that shows on a forward basis what the. I mean, look at the growth rates on these forward long-term earnings. Alphabet is about 16%. Amazon's about 17, Apple's about 11 because of all the share buybacks. Tesla's the only negative one. Damn it. I have to find it. But basically, if you look on a forward basis, they're not that expensive. Like Meta right now on a forward basis is 24. And I think Tom Lee brought up, if you look at like Meta, it's 24. Even Nvidia is like, actually, let me bring up that tweet real quick. 1 second. And I think that was a good point.
And so, yeah, I mean, it all depends. Like, if you're looking on a forward basis, like, it's really not.
Yeah. So if you look at Nvidia, it was at 168. On a forward basis, it's only 26. Costco is 47. Walmart is 34. You know, so who's more expensive, Nvidia or Costco and Walmart? Well, according to this, it's actually Costco and Walmart. The one difference that I think he should make sure that he clarifies, though, is that Nvidia is in a cyclical business. Chips are cyclical. No matter what anyone tells me, there are periods where everyone is like, I need chips, give me chips. And then there's a point where it's like, yeah, I don't need them. And what happens is if you have a cycle where you don't need as many chips, that cyclical business is going to go down, you know? And that's why I think the market at times does not give Nvidia the crazy high multiple that, you know, that it's giving Costco and Walmart. With Costco and Walmart, if you look at their business, let me just bring it up. Dashboard. Damn it. This is, I have to bring. If you look at Costco, look at their revenue. It's up and to the right. It is not cyclical. Look at that. Sorry.
I might be on the wrong screen.
Yeah, sorry. Let me just share my desktop. Sometimes I have to. Okay, there we go. Look at that. This is Costco's revenue, always up and to the right. Okay, when you look at Nvidia, Nvidia has a huge growth move right now, but if you look, you know, on a shorter term basis, during the crypto boom, it went up, and then as crypto died down, because that's what a lot of people were buying the chips for, it started to go the other way. And then during COVID, it started to go up because, you know, chips were running, and then they did proof of staking on Ethereum. So then chip sales started to go in the other direction, right? So it went down this way. And then AI in 23 comes along and it started to climb. So right now it's got this upward move. And so a lot of people are saying, well, how much can they justify this upward move? And how much of the free cash flow from a lot of these big guys? Because I mean, there's like 5, maybe 7 companies that are driving majority of NVIDIA's growth. Google, Microsoft, Amazon, Meta are driving this purchase of chips. How long do you think that they can keep that up? You know, and at what point does the growth rate on Nvidia start to go the other direction? Because you can already see growth went from 200% now to 71%. Right? At some point, the law of big numbers is going to come for Nvidia. And I think that's the problem that people have to recognize with companies like this, because there's a finite amount of dollars that companies can spend unprofitably. So look at OpenAI right now. OpenAI, they're growing like crazy, but at the same time, they're losing a lot of money. And so at some point, that cash flow is going to at least not be as strong as it was in prior years. And so if this happens, then the share price will follow suit. So, you know. So this is the part that I would say we have to be a little bit cautious and be careful. I'm not saying NVIDIA is a bad company. I'm not saying NVIDIA is not great. I think NVIDIA is great. Their earnings are great, all that good stuff. But just remember, you know, at any point, if NVIDIA's growth starts to really materially slow down and it starts to hit into like the 30s and 20s, we got a problem. And that's with people spending 165 billion a year on chips right now.
And that's, I mean, honestly, that's because, can you pull up the share price on top of that? Because like that's when I would love to kind of, in retrospect, like potentially buy. Awesome. I don't know why it's. Stock price, right?
Yeah.
That's potentially what I'd love to start potentially buying the
Yeah.
actual, because it's like if you go through the price as it's kind of
Yeah.
gone over time.
Let me just get rid of the change in revenues things, hide that. So you can see here, this is up and to the right, but once again, the share price went from $4 all the way up here to like 31 and then went back down to the 12s. Why did it go down 70%? Well, crypto had its moment where revenues are rising, and then guess what? The growth rate started to slow down, and then the share price went down along with it, and then eventually it picked back up. So anyone that says, hey, they can maintain a growth about 40% per year, I don't know if you could grow that much every single year. So
I would love. I mean, it's things like this, and this is another thing that, like, when I talk about crypto, like the cyclicality of it, it's like I'm long term, right? I have Bitcoin, I have Ethereum, but I see a lot of people piling into things, and to me, I wish everybody well. I hope they make money, but I hope that they are nimble if they honestly cannot handle the volatility of being in something like a crypto stock or treasury or anything like that, because the table will turn, and when it does, it's going to drop very, very quickly. And that's when I'm starting to look. I'm looking for great companies. I'm keeping my eye on BM&R. I think I love Tom Lee. I love what he's doing. My hope is and I hope, I hate saying this sort of stuff because I don't ever want anybody to lose money, but it's times like that where you see retracements in revenue, and you see crypto winter happening, and Bitcoin goes down to $15,000 in 2022 or whatever it was, that you're like, this is the time to start stockpiling. And other people are like, you're an idiot. I've literally been, by mostly Canadians, been told I'm an idiot for buying into Bitcoin during crypto winter in the past. And I'm just keeping my eye out. And every single time, especially during recessions, even with equities, every single time the market has pulled back, I've gotten much stronger because I know what great companies there are. And NVIDIA isn't one that I've ever really kept on my radar, and that's kind of been something that is stupid of me. Like I said, I don't hope anyone loses money, but this is one that I will potentially be looking at if it does retrace because of, say, lack of spending, and the revenue actually does go slightly pulls back. That it'll be interesting because, like you stated, chips are something that you always have to invest in. It might not be that year, but within a 5-10 year time period, you're always going to have to refresh things, because we know how quickly chips move. So to stay relevant and to be able to keep up with the future, you have to be able to purchase these things. So it's interesting. I'm keeping this one in my back pocket. And there's a gentleman that's asked about 15 times if I'm still selling puts on MicroStrategy. The answer is yes. Eventually, when I believe that we spike up, which I believe will be in the next 3 to 4 months, before the beginning of I don't know if it's going to happen before the beginning of 2026, but I believe by the end of 1Q 2026, we'll have hit the peak in crypto. And my thought process is by the time you get into the second and third quarter, we'll start to be into crypto winter. And so by that point, I will probably stop selling puts because I'll be waiting for a large retracement. And whether or not that comes or not, I'm just being nimble. And if it doesn't, then, but in the meantime, I'm selling puts, but I'm not getting super aggressive on the MicroStrategy puts that I'm selling. I'm just selling like 1 or 2 contracts. It's nothing that, like, if I had to get put the shares, that I wouldn't, it wouldn't bankrupt me or anything like that. So just, I hope that people are just expressing caution, because especially with selling puts, I think a lot of people think it's easy money, And it is easy money when the markets are going in the right direction for you. But when things turn in the wrong direction, you could be stuck with a bunch of stock that is about half the value that you thought it would be, and you had to buy it at full price.
Yeah. One of the things that I'm looking at, like if you look at this right here with Meta, their cash pile went from 43 billion now to 12 billion because they've spent so much money on chips. Right now, they generate about 103 billion in operating income. They're spending 52 billion in capex. So they're spending a lot of money on capex. They're still trying to maintain their share buybacks, by the way, which is nice for shareholder value. But let me see, shareholder returns. So cash flow.
Yeah, cash flow statement.
So if you look at their share repurchases, capex, repurchases, net issuances, repurchases, right here. So you can see so much of their cash is now basically being eaten up by capex that their actual repurchase common share repurchases have kind of flatlined a little bit, right? So that's something to keep in mind. At some point, investors are going to be like, okay, wait a second, like you're burning so much cash. What's going on here? Like, what's going on, Zuck? And then the news came out today that OpenAI might be what is that thing called? Might be doing their own social media platform that's like generated via AI.
Really? I didn't see that.
Oh, dude, it was on Twitter, man, and like everyone's kind of dogging on Meta because of that. They're like, oh, what if Meta gets disrupted because of that? So same thing with Google. What is that thing called? OpenAI announced that you're going to be able to basically just search for things, and then AI is going to be able to link to Shopify and Etsy and all these other stores and basically direct you to them. So instead of going to Google and searching for, ceramic dish plate or something, you can just search for it on ChatGPT, and ChatGPT can just hit you a selection, and then you just hit buy, and you can do it all from ChatGPT. So people are like, oh, maybe people will search for things on ChatGPT that they would normally search on Google for, and that could theoretically be a monetization engine for OpenAI, because OpenAI right now is getting a little bit, in my opinion, getting a little bit desperate for cash, because investors in OpenAI, they've been pumping in so much money and they've been losing so much money in doing this AI thing, that if they don't get a steady stream of cash flows coming in, that their investors are going to kind of be pissed and say, no, we're not giving you any more money until you show some tangible plans for a self-sustaining business. You can't operate a business losing 50, I think they lost almost $5 to $7 billion last year. Like, how long can you find that? So yeah.
Anyway, 2 hours. Appreciate as much time as you gave us, Mr. Patel. But I know, did we start an hour earlier than normal, or am I dumb?
No, we started at 10. This was a long stream.
Okay. Yeah, I wasn't sure. Do we normally start at 10 your time, or do we normally start?
I don't know, dude.
I always forget.
I always forget too.
I've been going back and forth in so many different time zones. I'm getting lost.
For me, 9, 10, whatever. It's like a couple hours is not going to make a difference. So,
okay.
Yeah. Cool. But if you like the content that we just did today, where we kind of analyze things, by all means, please subscribe. I think I'm going to try to get us a partnership with Fiscal AI. I think if you are an investor and you like trying to do more fundamental analysis, Fiscal AI really does a good job of bringing everything together in one thing. So maybe we can, there is maybe create like a referral link. This way we get a little bit of dough from it, and we can use that money to kind of just make the content on here a little bit better. I told Matt, one of the things that Matt has to do homework wise is get a iPad. That's right. And use Weeble on it. So that's the entire purpose of it. So
yeah. And we're trying to also get a potential link. I have a link in the description for Weeble. I think you can get like 4% if you transfer money or something like that. And Chris, you also had one. So I don't know if you want to post it in the chat or what, but the hope is eventually we can continue to do this. I love chatting with you, and a lot of people, man. For those of you that we haven't had the opportunity to see, the last 2 episodes, like Chris obviously went to Vegas and met a lot of people. I met a lot of people in Miami, and just the amount of joy that people came up to me and were like, I got so much value out of Cashflow Chronicles. I got so much value out of Chris. They didn't want to talk to me. I think they wanted to talk to me because I'm an extension of Chris. So no, I'm just kidding. But they get a lot of value out of this, and it's great because I get frustrated sometimes when I just hear people talking about hyping up stocks, and not everything is about fundamentals. Not everything is about the PE ratios. I think somebody put that very eloquently in the chat, and I agree. Not everything is about PE ratios, but you do have to look at company performance at some point from time to time. And I think we do a good job of laying down that law, because Chris and I talked about a stock yesterday, and to preserve people's feelings, I won't bring up which one, but I think he'll probably remember the fundamentals were not going in the right direction. And obviously the stock price followed very quickly. And me and Chris were very in alignment on trying to convince others that this is something that is not a good opportunity. And there was others out there that were preaching that it was. And unfortunately, there were people that did not do so well on that opportunity. It's not to say we're going to get everything right. Chris and I have been wrong, and I've been wrong probably more than I can count. But there are sometimes it's very evident that some things are not going in the right direction. But yet, because of hopium, sometimes people push things further than they should. So, Mr. Patel, anything else?
No, we're pretty good.
Awesome
man.
seeing you, man. Awesome seeing you.
Yeah, like I said, we're doing everything we can to try to build our networks now, because I think that's one of the things that I'm kind of focused on, because I do want to go to more of these conferences and meet people. A lot of times you get to pick people's brains that you normally would never get access to, and it makes you a good investor. It delivers a lot of alpha, and hopefully that alpha can be translated into value for you guys. So yeah.
You're the man. All right, everybody. Hopefully we can catch up on Thursday. It looks good for me, so I'll just check in with Chris that day of, and we'll make sure that hopefully it works, and hopefully we can get hot Steven Himmerillo, my name for Steven because he's him. Hopefully we can get on this. Has he released who his first channel guest is going to be?
No.
Or is it just going to be him trolling everybody, drinking a can of milk or something?
Can of milk?
Milk doesn't come. You never know. It might. You don't know that. I don't know. He's got that fancy New York milk, man. I don't know.
I've never drank milk out of a can, bro.
I don't know.
Yeah.
I meant to say carton, but can came out. So
can of milk.
You got some of that. Roll with it.
I've seen canned, like, no, I think I've seen like heavy cream. I think sometimes comes in can. Does it? I don't know. Whatever.
See, condensed milk. See,
condensed milk does. Yes, condensed milk does come in a can, but not regular milk.
Vietnamese coffee, bro. I would destroy one right now. Anyway, I shouldn't because I need to go to bed. But
that's right. We're trying to get healthy. That's the next goal. We've got our wealth. Now we got to get our health. So we're working on it. We're working on it.
All right, everybody. Thank you. Hopefully see you guys Thursday.
You want to hear something really funny before we go? I've actually been losing weight. And one of the downsides is I was kind of, like the center of gravity is like down here in the stomach. And so my stomach is starting to go down. Bro, I used to balance my iPad and like the stand on my belly. Right. And like the other day, it doesn't work so good because now my iPad keeps falling off because I've lost the weight. So it's like, this is a tragedy because I used to use it as like a little stand for my iPad. So it's a good thing and a bad thing at the same time. Yeah.
I didn't think about that. What am I gonna do? Because like I'm so used to you saw when we were in Mexico, I'm like using it and I'm literally just have my phone just like right here.
Yep.
Like now I'm gonna have to hold up my arms. Are gonna get tired.
Yeah. That's what I was doing. I usually like lay in bed with like a pillow right here and like the laptop right here, and it's so comfy. And then now I'm losing weight, and it's like,
oh man. So far, all the stuff in my midsection has always been positive, right? Like putting on shoes easier, like all that, socks easier, all that stuff. But man, now you're making me think, like, do I want to get that thin? Because no,
my t-shirts are coming loose a little too. So that's always like, now my clothes are starting to fit. Like the other day I went to a dinner with with some of my friends, and dude, the thought of wearing some of these khakis, I always get a little bit like self-conscious. Like, man, are these gonna fit? I bought these like 2 years ago, and now they're loose on me, so I had to grab a belt. I was like, oh, this is good. It's an improvement. Yeah.
Cool.
All right, guys.
Yeah. Thank you all. Yes, we're back, and we're hopefully going to do it twice a week, if not at least at a minimum, hopefully once. But no promises, but that's the hope, is twice a week. So
someone said there's milk in a can. We gotta find that can of milk.
Send it to Steve for his first show.
Yeah.
Cool.
All right.
Thanks, everybody.
Later, guys.